My name is Jesse Livermore, the great bear of Wall Street, and I'm going to tell you the one thing that separates the boys from the men in this game. The difference between making a few $100s and making millions. See, most people think trading is about being right. It's not. Any fool can be right about the direction of a stock. I've seen plenty of traders call a move perfectly and still walk away with nothing. The real question is, when you're right, do you make big money or do you settle for scraps? Today, I'm going to teach you about pyramiding, the professional secret weapon, the strategy that turned my correct hunches into fortunes. The fundamental mistake. Here's what the amateur does. He gets convinced about a stock. He's done his homework. He's certain it's going up. So what does he do? He loads up, buys his entire position at once. That's asinine. Why? Because the market doesn't care about your opinion. The market doesn't care how many hours you spent analyzing that company. The only thing that matters is whether you're right, and the market is the only judge of that. So here's the first rule of pyramiding. Let the market prove you're right before you make your big bet. The testing order. When I like a stock, I don't rush in. I make what I call a testing order, a small purchase. Maybe I want to eventually hold 40,000 shares of something. You know what I buy first? 5,000, maybe 10,000. That first purchase, it's not an investment. It's a question I'm asking the market. I'm saying, am I right about this? If the stock goes against me, the market just gave me my answer. I was wrong. And I paid a small tuition to learn that lesson rather than losing my shirt. But if that stock shows me a profit, now we're talking. Now the market is confirming I'm onto something. Now I have a trading basis to start building a real position. The scaling up method. Here's how I do it. Let's say I bought those first 10,000 shares of cotton and the price moves up 10 points. Beautiful. The market is telling me I'm right. So I add another 10,000 shares. By the time I have my full 40,000 or 50,000 bales, I'm sitting on a position that's already substantially profitable. Even if the market turns against me, I'm still ahead. Wait for the reaction. Now, after you've made several purchases on the way up, here's what you do. Nothing. You wait for a reaction, a dip. This is crucial. This is where you separate the real moves from the false ones. Watch how the stock behaves when it pulls back. Does it get absorbed easily? Do buyers step in? Does it rally back to the previous high without much trouble? If yes, that's when you shoot the rest of your line. That's when you go all in, because the market just told you. The buying power is real. The trend is established. The Deacon's lesson. Let me tell you about Deacon S.V. White. He heard rumors that insiders were buying sugar, but the deacon was smart. He didn't just take their word for it. First, he sold 10,000 shares to test the market. The stock absorbed it without flinching. He sold another 10,000. Still no break. That's when he knew the buying power was real. So what did he do? He covered his shorts, flipped long, and went in for 30,000 shares. Made a killing. He let the market prove the rumors were true. That's professional trading. The Union Pacific hunch. Let me tell you about one of my greatest trades. Spring of 1906, Union Pacific. I was on vacation in Atlantic City, watching the board. Suddenly, I got this feeling, an irresistible impulse to sell Union Pacific. There was no logical reason. The market was strong. Everything looked fine. But the feeling wouldn't leave me, so I tested it. Sold 1,000 shares at the market. The stock didn't rally like it should have. The feeling persisted. So I added another 1,000 shares short, then another 1,000. That was 3,000 shares, all based on nothing but a hunch. But I was letting the market tell me if I was right. Then the news broke. San Francisco earthquake. At first, the market ignored it, but I knew. A major city had just been destroyed. This was real. This was my opportunity. As the market finally began to slide, I pushed my luck for all it was worth. I doubled my position, sold 5,000 shares more. The market kept confirming I was right, so I doubled again, another 10,000 shares. I wasn't betting blindly. I was pyramiding on a winner. Each time the market moved my way, I added more. The destruction of San Francisco couldn't be undone overnight, no matter how much money anyone threw at it. Cleared $250,000 in just a few days. Started with a 1,000 share test based on a feeling. Ended with a fortune because I pyramided correctly. The disaster of averaging down. Now let me tell you what not to do. The opposite of pyramiding, the thing that nearly destroyed me. Cotton, 1907. I met Percy Thomas, a legendary cotton operator. Brilliant man. Had data from 10,000 correspondents across the cotton belt. He convinced me that cotton was going up. Problem was, I had been bearish. I was short and making money. But I let Thomas talk me out of my own judgment. I got Thomasized. I covered my profitable shorts and went long. Bought 40,000 to 50,000 bales. Then the market went against me. And here's where I made every mistake in the book. I was also carrying a big line of wheat that was showing a nice profit. The professional rule is simple. Sell what shows you a loss, keep what shows you a profit. What did I do? I sold my winning wheat position to lighten my load and kept my losing cotton position. Then it got worse, much worse. I started buying more cotton specifically to keep the price from going down. I was trying to support the market. Eventually, I was holding 440,000 bales. 440,000 bales of a losing position. That's the super sucker play. Averaging down, adding to losers, trying to prove you're right instead of listening to the market. Everything I had. The small increment trick. Here's a technique I learned from Pat Hearn that keeps you disciplined. Buy in small increments as the stock moves up. Maybe 100 shares every time it gains 1%. But here's the key. Keep a stop-loss order exactly 1 point below your last purchase price. What does this do? It ensures that if the market suddenly turns, you get stopped out with a profit or a tiny loss. You're protecting your gains while still giving the stock room to run. It's mechanical. It works. The psychological edge. Here's what people don't understand about pyramiding. It's not just a mathematical strategy, it's psychological. When you pyramid correctly, you're building confidence in real time. You're only increasing your risk as your paper profits grow. You're never exposed to maximum loss. This gives you the courage to sit tight, to let your winners run, to push your luck when you're hot. I'll tell you something. Millions came easier to me after I learned to trade than hundreds did in my early days. Why? Because I learned to pyramid. I learned to sit tight on a winning position and keep adding as long as the market confirmed I was right. Bethlehem Steel, a perfect example. I waited 6 weeks for it to cross par at 100. Just watching, waiting. Finally, it hit 98. I bought 500 shares, just testing. By that night, it shot to 114. The market just handed me 16 points profit and confirmed my read. So what did I do? I used that profit to add another 500 shares. The next day, it was at 145. I kept building. A small start turned into a substantial stake because I added to a winner, not a loser. Let me give you one more example of discipline. I once started positions in both U.S. Steel and Utah Copper at the same time. Steel acted right. It moved the way I expected, so I kept adding. Eventually held 72,000 shares. Utah Copper, it didn't behave the way it should have. Something was off. So you know what I did? I refused to add beyond my initial 5,000 shares. Steel made me a fortune. Utah Copper, I got out with a small loss. That's the discipline of pyramiding. You pile into the winners. You abandon the losers. The final lesson. Here's what it all comes down to. Pyramiding allows you to have your big bet down only when you're winning, and to lose only a small exploratory bet when you're wrong. It's not your thinking that makes you money in this game. Any amateur can have opinions. It's your sitting tight on the right positions and adding to them that makes the big money. The market will tell you if you're right. Listen to it, respect it, and when it confirms you're on the right side, that's when you step on the gas. Start small, test your thesis, let the market prove you right, then pyramid like your life depends on it. That's how you make real money in this game. That's how I made mine.